What if I told you that just a few $1 million entering the XRP market could make its market cap increase by billions of dollars? At first, that sounds impossible. Most people hear that claim and immediately think, there's no way that's true. If XRP is going to reach a much higher price, it would take trillions of dollars flowing into the market. It's one of the biggest misconceptions in crypto, and it's exactly why so many people dismiss XRP price discussions before they even understand how market capitalization actually works. In today's video, we're going to answer a simple but incredibly important question. How can only a small amount of new money create such a large increase in XRP's market value? This isn't about hype. It's not about predicting that XRP is going to $100 tomorrow. And it's definitely not about telling you that every small green candle is the beginning of a bull market. Instead, we're going to break down the math behind market capitalization in the simplest way possible, because once you understand this concept, you'll never look at crypto prices the same way again. Let's start with something that almost everyone gets wrong. Many investors believe that if XRP ever reaches a market cap of $1 trillion, that means $1 trillion had to flow into XRP. That's not how market capitalization works. Market cap is simply the current price of one coin multiplied by the total circulating supply. For example, if an asset has 1 billion coins in circulation and each coin is worth $1, the market cap is $1 billion. Now imagine buyers become more aggressive than sellers and the price rises to $2. Did another $1 billion actually enter the market? Not necessarily. The market cap doubled because the last traded price changed, not because the same amount of cash entered the asset. That's a critical difference. Think about a house in your neighborhood. Last year, a similar house sold for $300,000. Today, another identical house sells for $330,000. Did every homeowner on your street receive an extra $30,000 in cash? Of course not. But on paper, the value of every similar house in that neighborhood just increased. Markets work the same way. The latest transaction helps determine the market value of all similar assets. Crypto is no different. That's why market capitalization can move much faster than the amount of money actually entering or leaving the market. Now, this doesn't mean prices can rise forever with almost no money. Liquidity, order books, trading volume, and market conditions all play a huge role in how prices move. But it does explain why relatively small buying pressure can sometimes produce much larger changes in overall market value. And that's where the conversation around XRP becomes really interesting. Supporters of XRP often point out that when liquidity is relatively thin, even modest net inflows can have an outsized effect on price and market capitalization. Critics hear that and immediately assume people are claiming billions of dollars appear out of nowhere. But that's not the argument. The real discussion is about how markets price assets, not how much cash physically sits inside them. Now let's answer the question everyone wants to know. How can just a few $1 million create billions of dollars in market value? The key is understanding the difference between money entering the market and how the market values an asset. These are not the same thing. Imagine there's an auction with only 10 rare paintings. The first painting sells for $1 million. A few minutes later, another buyer purchases a similar painting for $1.1 million. Did everyone suddenly pay an extra $1 million? No. Only one transaction happened. But because that was the latest market price, every similar painting is now considered more valuable. That's exactly how financial markets work. Stocks, real estate, gold, and cryptocurrencies. The last traded price becomes the reference point for the entire market. Now let's apply that idea to XRP. Imagine buyers begin stepping into the market faster than sellers are willing to sell. To complete those trades, buyers must offer slightly higher prices. As those transactions happen, the market price moves higher. Once the price increases, the market capitalization also increases because it's calculated using the new market price multiplied by the circulating supply. Notice what happened. The market cap increased dramatically, but that doesn't mean the same amount of money physically entered the market. That's why you'll sometimes hear analysts talk about a market cap multiplier. It's simply the observation that relatively small net buying pressure can sometimes produce a much larger increase in market value, especially when liquidity is limited and sellers aren't aggressively offering coins at lower prices. Now, it's important to avoid a common misunderstanding. This does not mean every single dollar creates hundreds of dollars in value forever. Markets don't work that way. The multiplier changes constantly. It depends on liquidity, trading volume, market sentiment, order books, and overall demand. During periods of heavy buying, prices may move faster. During periods of heavy selling, the exact opposite can happen. That's why crypto markets can feel so volatile. A relatively small imbalance between buyers and sellers can move prices much more than many new investors expect. This is also why you'll often see headlines claiming that a cryptocurrency gained billions in market value in a single day. Some people assume billions of new dollars must have entered the market. In reality, the increase reflects how the market is valuing the asset at its latest trading price, not a direct measurement of cash flowing into it. Now let's connect this back to XRP. Many XRP supporters believe that if institutional demand eventually grows through payments, tokenization, or other real-world use cases, even moderate increases in buying pressure could have a meaningful impact on price, because markets reprice assets based on supply, demand, and available liquidity. That doesn't prove XRP will reach any specific number. It simply explains why some analysts argue that future price movements aren't determined solely by the total amount of new money entering the market. Understanding that distinction helps remove a lot of confusion surrounding market cap discussions. So, does this mean XRP is guaranteed to reach massive prices just because market cap multipliers exist? No. Market cap multipliers help explain how prices can move, but they don't predict where prices will go. For XRP to achieve significantly higher valuations, the market still needs real demand. That demand could come from increased adoption, stronger liquidity, institutional participation, or broader use of blockchain technology. In other words, the math explains what's possible, but utility helps determine what's sustainable. That's the key difference. So instead of asking, does XRP need trillions of dollars to rise? A better question is, can growing demand create the buying pressure needed for higher valuations over time? That's the conversation investors should be having. Now I'd like to hear your opinion. Do you think market cap is the most misunderstood concept in crypto, or do you believe something else plays a bigger role in XRP's future? Leave your thoughts in the comments below. I read as many comments as I can. If you enjoyed this fact-based explanation and want more XRP videos that separate facts from speculation, make sure to like this video, subscribe to OG John XRP Insights, and turn on notifications so you don't miss the next one. Thanks for watching, and I'll see you in the next video.